the Fed has made it clear that they actually want higher unemployment or need higher unemployment. They're preparing us for a recession. I don't think the Fed is going to pivot or lower interest rates based on unemployment, based on the economy, or based on the stock market. They don't care about the stock market right now. They will pivot based on another financial crisis, in my view.
All eyes are on what the Federal Reserve is about to do next as we enter what they've announced as a mild recession, which could come later this year. Adrian Day joins us today. He is the CEO of Adrian Day Asset Management. Adrian, what a pleasure to host you. Welcome to my new show.
Well, thank you, and congratulations on your new show, David.
Thank you very much. Adrian, I want to talk about the Fed's meeting minutes first that came out last week. I don't know exactly what mild means. I'm here to ask you. Perhaps you have some thoughts as to what they mean. And I want to ask you also what they're going to do next now that they've admitted that we're entering a mild recession.
Yeah, and they did say the end of the year. They didn't say we're in a recession now. But, you know, it's very clear to note that the Fed has been lagging a lot of economic commentators for a while. I mean, remember all the talk about no landing, and then we went to a soft landing. And even after the last meeting, the minutes hadn't come out yet, of course, but he knew what was in the minutes. Jerome Powell said, there's still a path to a soft landing. We just have to find it, which I thought was astonishing. But the point is that they always seem to be so clearly the trajectory of Fed commentary on a recession is getting worse. And you mentioned the Fed minutes, and we know that the Fed minutes are not real minutes. The Fed minutes are massaged after the meeting to send the message that they want to send based on when they release them. So the message is continuing to deteriorate. And I wouldn't frankly be surprised if in a month or two, the next thing we hear is, you know, that a recession is almost upon us and is going to be worse than we feared.
Well, what's remarkable to me is that even after the release of these minutes, the market seemed to shrug these comments off. The S&P 500 continued to grind higher. Why do you think that is?
It's astonishing. I think there's a couple of things. Fundamentally, there's a lot of money on the sidelines. Let's not forget that. A lot of whether it's the wealthy 1% or wealthy 10% or whatever, but there's a lot of money on the sidelines that's been there through the 10 years, 12 years of easy money that's built up. That's one thing. And there are fewer places to put that money. You don't want to be buying bonds at this point. You don't want to be buying real estate. You don't want to be buying crypto. And so stocks are the obvious place for a lot of that money to flow. But I think also the market has decided that the Fed either has or will pivot. And to me, the last meeting was by no means a pivot. It was a shift, if you want, a shift in emphasis, but it was not a pivot. But if you look at the Fed futures, the Fed funds futures rate, they're looking for 75 basis points by the end of the year. That to me is very optimistic. I'm not saying it won't happen, but I'm saying that's a very optimistic assessment.
I have to add that not everybody within the Federal Reserve agrees with the notion that a mild recession is on its way later in the year. Yesterday, St. Louis Fed President James Bullard told the Reuters reporters in an interview that he said Wall Street's very engaged in the idea there's going to be a recession in 6 months or something, but that isn't really the way you would read an expansion like this. He's advocating actually for a continuation of raising interest rates. Can you break down what perhaps is on his mind and what data he's looking at to suggest that the economy is still expanding?
Yeah, well, there was clearly some difference of opinion at the last Fed meeting, more difference of opinion than we've seen at previous meetings. And I think that was clear more in Powell's press conference that came after the meeting. Than perhaps in the minutes, but clearly there's two camps at the moment on the economy. It's interesting to me that a lot of the non-voting members, we had 4 of them, I think, in the last 5 days, 4 of them have come out with comments calling for higher rates. And this is often a pattern we see ahead of the blackout period that comes ahead of the Fed meeting, when Fed officials can't speak about it anymore. You get a lot of non-voting members calling for higher rates to prepare the market. The economy at the moment is really, I read something this morning that called it Jekyll and Hyde. The economy at the moment, for every positive report that comes out, we suddenly see a negative one, and then we see another positive one. There's certainly some positives. You look at the unemployment rate, and we know that the Fed is concerned about the unemployment rate as part of their mandate. So if you just look at the unemployment rate and nothing behind it, like the low labor participation rate, just look at the unemployment rate, that's positive. You look at manufacturing. Remember the Empire State Manufacturing Index went up last week. So there are some positives, but to me, there's a lot more negatives in the economy right now, whether it's credit card balances, credit card write-offs, corporate bankruptcies, initial claims, a lot more negatives. And of course, the leading economic indicators is down in the last month reported, which was February. They haven't reported March yet. That was down for the 11th consecutive month. So on balance, although there's some positives, and the positives tend to be in the headlines. Consumer spending's okay, unemployment rate's way down, manufacturing's up. The headlines tend to be positive. But if you look under the surface, to me, there's an awful lot of trouble brewing. And credit card balances is a clear sign that the consumer spending can't continue.
Okay, let's talk about credit card spending. I've heard the argument that even if the Federal Reserve were to lower interest rates, pivot by the summer. I'm not saying they will, but just suppose they do. Credit card balances will still be affected in the sense that consumer interest rates typically lag the federal funds rate by a little bit. It's not that just because the Fed funds rate comes down by 25 basis points, your credit card interest expense or rate is going to come down right away as well. Is that something you've observed?
Oh, absolutely. No question. The rates tend to go up faster than they come down. There's no question about that. And let's look at, put it in personal terms. Look at a family where they have a little bit of savings that they built up in COVID. Maybe they pay off most of their credit cards most of the time, but then, prices start going up. We've seen the inflation. Prices start going up. Perhaps one of the two householders loses a job or goes to part-time or something. And initially, they try to continue the spending pattern for their family, right? The kid needs new shoes, they buy new shoes. The kids want Snap, Crackle, and Pop cereal, they buy it. But what happens is they're depleting their savings, and we saw that for the second half of last year. The savings started to come down. They're still high on an absolute basis because of the savings that were built up during COVID. But the savings rate has collapsed and the savings themselves came down. And then suddenly this family finds they have no savings. So what do? They try to continue to maintain their standard of living by using credit card debt. But a point is reached and the credit card interest rates go up pretty rapidly. So if I were able to pay off, let's just say $3,000, $4,000 a month in credit card debt, I was able to pay it off, but I let that lag. And now I've got $10,000 in credit card debt with a 20 or 25%, and some credit cards are as high as 29%, but a 20% credit card interest rate. Even if I continue to pay my $3,000 a month, I'm still not getting ahead. That's the key. So when the debt gets built up, it takes a lot more to get ahead of that debt and to bring it down. Remember, credit card debt is daily compounded interest. And so it builds very, very rapidly. And so a lot of people now, if you're paying your $3,000 that you've always paid, most of that $3,000 is only going to service your debt. It's not bringing your balance down very much. So yeah, I think the other side of this is going to take a lot longer for consumers to get out of.
I wonder how much of the ballooning balance on paper was due to higher inflation. It's not that people bought more goods per se, perhaps they did. It's just that what they used to buy became more expensive.
No question. No question. And yeah, absolutely. I mean, if you look at last year, consumer spending went up a little bit, but it did not go up 8 to 10%, which means consumers were not buying more in terms of volume. They were just paying more for it. And they were having to shift downwards from, brand names to store names and that sort of thing. The Walmart CEO made a very interesting comment about the shift in the demographics shopping at their stores, seeing a lot more middle class and upper middle class people buying at their stores than they traditionally see. And that, I think, is just a sign that people initially are not willing to stop spending or give up things, but they need to and are willing to just come down in quality a little bit, or perceived quality.
I'm going to come back to the labor market and the economy in just a bit, but let's finish up by talking about the Fed. What do you think they're going to do then, given everything we've discussed so far? What is their most likely course of action first on their May 3rd meeting and then later in the year, you think?
Yeah, I think they'll probably do one more raise in May, given all of the telegraphing we've had, not just from Fed spokesman, but also from the Wall Street Journal Fed mouthpiece. Excuse me. So I think they'll do one more quarter point, but that'll probably be the last one, I suspect. I'm not looking for a dramatic pivot. Certainly not in the next 6 months. The Fed has made it clear that they actually want higher unemployment or need higher unemployment. They're preparing us for a recession. I don't think the Fed is going to pivot or lower interest rates based on unemployment, based on the economy, or based on the stock market. They don't care about the stock market right now. They will pivot based on another financial crisis, in my view.
Wait a minute. You said something key. Let's come back to that. The Fed wants higher unemployment. What makes you figure that?
The Fed wants higher unemployment because they want to see aggregate demand decline. The only way to reduce inflation is to get aggregate demand down. And so high employment, low unemployment is fighting against them on this.
Well, do you agree with the economic theory that there is a direct relationship between labor market strength and inflation? I mean, we see this in the Phillips curve, for example, which some economists have refuted. There's an inverse correlation between the unemployment rate and inflation. Is that something like when you think about inflation and you think about the causes of inflation, is one of them a strong labor market?
The fundamental cause of inflation, I'm a monetarist on that. The fundamental cause of inflation is excess creation of money, whether it's by the banks or by the Federal Reserve. And the banks can't create excess money unless the Federal Reserve is at the back of it. So excess creation of money, you have to have excess creation of money in order to have inflation. You can have individual factors that cause certain prices to go up, as well as other prices to go down. But if you don't have excess money creation, you can't have a rise in the aggregate level of prices, which is what we've been seeing for the last 12 months. Labor's interesting now because clearly labor has more bargaining power today than it did, let's say, a year or two ago, but it's still nothing compared with what it was 10 or 20 years ago. And as we talked about before the show, although the unemployment rate, the nominal unemployment rate is down, that really masks an awful lot of other things going on in labor. Now, I don't pretend to be a labor economist, but you look at the labor participation rate, which is under 70%, that's astonishing. You've got a lot of people just not going back to work, whether because they took an early retirement or they can't find a job, or they're not looking for a job, frankly. Remember that the Biden administration undid the requirement to look for a job in order to get unemployment that came in with Gingrich and Clinton back in the 1990s. Remember the big welfare reform was you actually had to be looking and you had to accept certain work in order to continue to receive unemployment pay. And that was done away with because of COVID and so on. And it still is the case. So there's people receiving unemployment pay from the government who are not looking for a job or not, and other people who are not finding the kind of work they want. Remember, if you're a white collar guy who's been laid off from some office and they're offering you jobs flipping hamburgers, you don't want that. So you just keep looking. So I think, but you might take it if you have to, right? So you take it, you don't count as unemployed, but it's not the kind of job you're looking for. So I think the labor market is much, much weaker than the unemployment rate would show. Yeah. And then we could, sorry, go on.
Oh, no, I was just agreeing with you. Please continue.
No, I was just going to say, as we were saying before the show, there's company after company announcing these massive layoffs. And remember, if people get severance pay, they don't count as unemployed until the severance pay ends. That's certainly a big factor for people in Silicon Valley who get laid off. You know, they may have severance pay for 6 months or something. And so they don't count as unemployed until the severance pay runs out.
It's very interesting. You brought up looking under the hood of the unemployment rate. On paper, the unemployment rate, if you just look at, the 3.5% number that came out in the last jobs report, it looks like it's getting better, not worse. But you're right. Looking under the hood, there's some problems, particularly if you break down the reasons for unemployed. This was brought to my attention by another economist who I spoke to earlier in the week. And he pointed out that the permanent job losers, people who have been fired, that number has been increasing. In January, it was 1.25 million, then 1.38 million in February, and then 1.5 million in March. What's been propping up the labor market is the number of re-entrants, but that's been dwindling.
Right. You're right. And again, it could be a 60-year-old person that sees inflation going up, was expecting to live off Social Security and pension, but can't, and so decides, just to go and get a job at a store or a job in a restaurant. They now count as employed.
So let's talk about the markets and what this means for investments and investment implications. So let's assume you're right. We're going to get one more rate hike, no pivot in sight for the foreseeable future for the next 6 to 8 months. The Federal Reserve wants unemployment. Let's assume they get what they want. We're going to get a weakening labor force. We're going to get a weakening economy and perhaps a mild recession later in the year. How do you think the stock markets in the U.S. will react to this confluence of weakening macro forces?
Yeah, well, first of all, I think we're going to get far worse than a mild recession. But for various reasons, mostly because we had loose money for so long, but households actually had more savings going into this recession than they did, say, going into the 2008 recession. So the cushion is a lot longer. So I think it's just going to take longer until we get into a deeper recession. I think in the near term, the market will continue what it's been doing, which is, up and down, but with a bias to the upside. A quarter point is priced in now. So I don't think a quarter point is going to make any difference to the stock market. And frankly, tough talk from Jerome Powell, I don't think will make much difference because, we're used to that, as it were. So for the near term, probably until May or June, I think the market is going to continue to go up.
Perhaps a complete deterioration of the economy, a severe recession could, I'm just saying could, not definitely, but could be positive for the markets because that would force Jerome Powell and the rest of the Federal Reserve to seriously think about not just lowering rates, but renewed quantitative easing. Would it not?
Yeah, no, absolutely. But I don't think we're going to see the Fed reverse course quite so easily. Maybe they'll keep interest rates up and at the same time go back to a balloon in the balance sheet, so fighting both sides at the same time. But I don't see them bringing rates down anytime soon. But you raised a really interesting point there, David, that I hadn't talked about with regard to the stock market. The stock market is not pricing in a serious recession. If you look at S&P earnings as per consensus earnings estimates, they've increased. The gap between last year and this year, the decline expected in S&P earnings has increased in the last 3 months, but it's still less than 2%. The market is looking for S&P earnings to decline less than 2% in the next 12 months than they were in the previous 12 months. Given that the previous 12 months was a strong earnings because of the rebound coming out of the COVID situation, I think that's still very, very optimistic. And so I suspect that we could easily see an earnings-driven decline in the stock market when those earnings estimates prove to be too optimistic. I don't know if that'll come this earnings season or if we have to wait another quarter for the next earnings season.
Suppose that the Federal Reserve and economists like yourself are right and that we're going to get a mild to more severe recession later in the year. How will markets reprice?
Well, you look at where the S&P is right now at almost 19 times earnings multiple. That's certainly lower in the last couple of years. It's certainly lower than 2000 at the dot-com, but it's at the higher end of the 20 or 30 year range. So markets are still expensive, and the market is only expecting earnings to go down. It's about 1.5% is the earnings estimate. So if you see earnings decline by 5%, not a lot, you would typically expect the PE multiple to contract. When earnings decline, the PE multiple contracts. So if the earnings multiple returns to, let's say, 16 times, which would be still on a longer term historical basis, would be above average. But let's say they go back to 16 times and earnings decline by 5%. You put those two together. My math's not too good this morning because of my flu virus. I'm sorry, but that's about an 18 to 20% decline in the stock price, and I think that is perfectly reasonable to think we're going to see a 20% decline in earnings, and especially as the economy goes into recession, certain sectors are going to be hit very, very hard.
That was my next question, the sector performance. Any particular sectors that may weather this storm?
Consumer goods will depending on what they are, will typically hold up well. Companies like Nestle, for example, they typically hold up well during an economic slowdown. My number one sector right now, no surprise, will be gold and gold stocks for a lot of reasons. I've been suggesting that gold is due for a pullback in the near term, and I think we're in the middle of that right now, and we could see significant pullback in the gold stocks, because gold stocks always attract nervous money, short-term money, hot money, and so on. So I think we could see a pullback in the gold stocks, but that's just on the immediate term. We go further out. The gold market is realizing that the Federal Reserve will be unable to bring inflation down to 2% and do it without causing a serious recession. So we run the risk of persistent inflation. And again, I should say that the CPI may well come down again for the next 2 months as we see lower rental apartment rents coming into the CPI. That's always a bit of a lag. So for the next couple of months, we may see the CPI come down. just saying that so people don't get, think it's all over. But then we're going to see the CPI move back up again, especially with the oil price having moved second half of March and into April. So that will begin to have an impact when you look at April, and more importantly, for the full month of April, when you start to see it April and May, the higher oil price will have a higher impact on CPI. So I think we're going to see persistent inflation, even if it's only at 4 or 5%, we're going to see persistent inflation at the same time that the economy is deteriorating. That's stagflation, and gold is the number one asset for stagflation.
Just a quick note on that. That typically doesn't happen, Adrian. Typically in the past recessions, we see inflation come down. I'm not saying we've had deflation necessarily all the time, but inflation has usually in the past, during the recessionary period, come down, not stay elevated like what you said. You're saying oil is the main cause of your prediction?
I think oil would be certainly one prime reason for prices staying relatively elevated. A lot depends on the type of recession we get, obviously. If we get a very, very sharp recession in which consumer spending declines significantly, then obviously the price of the rate of inflation will decline. But I don't think we're heading into a deflation by any means.
What's your take on the price of gold in the short term? Why do you think it's due for a short-term pullback?
Oh, simply because, you look at gold, it went up $200 in less than a month. That is a dramatic move that you don't see very often. Certainly you don't see that sustained. And that price was ahead of and around commentary about the Fed pivoting. And again, I think just like the stock market, I think the gold market overreacted to the shift in Fed policy at the last meeting, the shift in Fed commentary, I should say, at the last meeting. It was not a pivot. And so if gold is moving up based on the Fed pivot, and it becomes clear in May at the next meeting that the Fed hasn't pivoted, I think gold could see a pullback, especially after the strong move we've had. Remember, some of the gold stocks are up 30, 40% in a month. I mean, it would be very optimistic to expect that to continue.
But it's once the stagflation hits that gold will start seeing outperformance again. Is that what you're saying? Correct.
So I want people to focus on the longer term rather than the shorter term. But people should realize that the next week or 2 or 3 could see lower prices. And to me, that will be an incredible opportunity to buy. Because it's increasingly clear that the Fed cannot bring inflation down to 2%, which incidentally to me, that's not stable money, but that's a whole totally different issue. But they cannot bring inflation down to 2% without causing a serious recession. And when we have a serious recession, which might come later in the year, then the expectations of lower interest rates start to increase at that point.
Maybe in the back of their minds, nobody cares about 2% inflation anymore. Maybe 4% is a new 2%, if you know what I mean. That's just a new stable inflation rate. But to your point about gold going up, suppose you're right that gold goes up later in the year. But once again, after this slight pullback that you're talking about, how would you play it? Presumably, it's a tough place because if one were to expect gold to go up, you would want to lever up on the juniors perhaps to capture the higher beta. But at the same time, if the stock market goes down, I wonder how that will impact the gold miners if the stock market goes down while gold goes up.
Yeah, no, absolutely. And there's a lot of factors that go into it. Let me first of all answer a different question, if I may, and that is gold in recessions. Because that's clearer. We've got much clearer and more one-sided evidence for how gold and gold stocks react in recessions. And the plain fact is that if you look at the last 7 recessions in the US going back to the end of the 1960s, gold went up during the recession in every one except one case. And in the one case, it was down. That was 1980. It was down by less than 0.5%. And that was when the central banks, remember when the central banks started dumping their gold? And they had to bring in the gold agreement. And so gold does very well during recessions. What about gold stocks? Because everybody says, well, in a recession, the stock market will go down, gold stocks will go down, so on and so on. Gold stocks have gone up in a majority of recessions, and they've gone up by 40%, 190%, 37%. I mean, big returns during recessions. And in the three cases in which gold stocks decline during recessions, in the three cases, in each case, they outperform the S&P, and by reasonably wide margins. So I think gold stocks are clearly a good place to be during recessions. You know, if we have a market crash, which I'm not expecting, but we have a sharp crash, and by sharp, I don't necessarily mean 1987, you know, a 1 or 2 day thing. 2008 was reasonably sharp as well. We would expect the gold stocks to decline as well, because we would expect them to decline as well. But history teaches us that the gold stocks tend to recover before the broad market does. That's particularly true if the gold stocks did not participate or were not leaders in the bull market. Now, they've been leaders this year, no question. But if you look at the bull market going on for the last 5 years, nobody's going to say the gold stocks were the leaders in that bull market, right? So if the gold stocks were not leaders in the bull market that preceded the crash, they will decline, but they will tend to bounce back much sooner. And 2008 is a good example. As you know, the gold stocks bottomed in September, I think it was, beginning of October. They started declining ahead of the S&P. They bottomed at the beginning of October, but they had already doubled. The XAU had already doubled before the S&P bottomed in March 2009. So, and we can see that in other examples as well. 1987 is another example when gold stocks recovered quicker and faster.
Going back to the size, any preference, juniors versus the majors? You know,
at the moment, the senior gold stocks are still very, very undervalued. And when you have a bull market in gold, the senior miners tend to be the first to move and the more certain to move. You know, if you buy the 5 or 6 largest gold miners, you're pretty sure if gold goes to 2,000, 2,500, you're pretty sure that at least 5 out of the 6 are going to go up, right? You're pretty sure. You buy Consolidated Moose Pasture, it may or may not give you outsized returns, but it may also, you know, give you a goose egg, to mix a lot of metaphors there. So at the beginning of a bull market, the senior stocks are much more certain to move. You still have to be selective because there's no sector out there, maybe biotech, but gold stocks are one of the most idiosyncratic sectors out there, meaning, you know, at the same time that some stocks will do very well, other stocks will do very badly. So selecting is very important. But just to get back to how cheap the stocks are, you look at the XAU, or indeed look at Agnico, which is the 3rd largest now. It is trading today at its lowest price to book, other than the end of 2014, the lowest price to book in its history. And that's with gold at almost $2,000. Price to cash flow, price to earnings, price to free cash flow, on all those metrics, the stocks are in the lower 10 percentile or the lower 25 percentile of their long-term historic average multiples. And that simply doesn't make sense where we are with the gold price, what the outlook is for gold. The gold stocks are remarkably inexpensive right now.
I'd imagine their margins would also improve this year if prices remain around the $2,000 level. I'm talking about gold, while inflation comes down from last year's level, at least. So,
yeah, absolutely. And people have talked about, well, you know, we've had inflation, so cost inputs have gone up. And And the cost input for most of the miners that I talk to, I mean, energy is the number one cost input of mining, and second cost input is the local currency. If you're a Canadian company operating in Chile, the Chilean peso, or if you operate in Australia, the Australian dollar, etc. Those are the main inputs. But what's really hurt the miners in the last 12 months are the price of a lot of smaller items or relatively smaller items, whether it's arsenic or spare parts for mills or, sorry, diesel and so on. Diesel is energy, of course. But you look at the margin, most of the senior miners have an all-in sustaining cost of 12 to 1300. If you've got an all-in sustaining cost of 1300 and you're selling for almost 2000, that's a pretty darn good margin. And remember, that's all-in sustaining. If you look at the cash costs, a lot of the cash costs are $800 or $900. Very, very robust margins. And in fact, the margins of the entire sector are much higher today than they were 12 and 24 months ago, despite inflation, the margins.
Finally, Adrian, before I let you go, what are some places that we could diversify to outside of gold and U.S. consumer staples?
Yeah, well, very quickly, let's see. First of all, in the US, I like the sector called the business development companies. These are companies that lend money to small and medium-sized businesses. And when people are worried about a recession or a financial crisis, the stock prices tend to come down. The business development companies are not at all in the same situation as the banks. They match the duration on their assets and liabilities. Who would have thought of doing that if you're a bank? I'm being facetious. They match the assets and liabilities, and they have very low leverage. By law, they are limited to 2-to-1 leverage, but most of them are 1.2, 1.3 times leverage. So the leverage is lower than banks, and the durations are matched. And traditionally, if you look at recessions, they tend to hold up quite well in recessions. And the yields are remarkably strong because the stock prices have come down. Do you want a specific one or not? Like Ares Capital, which is the largest of the BDCs, ARCC, is yielding almost 11% right now, and they're earning that. So that's one place I like for part of the portfolio. I also like some other commodities, but I think you have to be a little bit patient, not too aggressive on some of the other commodities. But I like the commodities where there is a potential supply issue as well as potential demand increase. So copper, for example, excuse me, would be my number one pick among other commodities. And then in other markets, I'm being very, very cautious and selective in global markets right now, because what we've seen in the US, to some extent or another, is replicated around the world. You know, Europe is heading into a recession. Europe has high inflation. The UK numbers came in over 10%, the latest number, and they're heading into recession. And in most markets you look at, I would say that the risks outweigh the opportunities. But a couple of places I'm looking, one would in fact be the UK. I think UK stocks are very inexpensive right now. If you just look at the price, they're inexpensive. But if you look at the valuation, trading at 10 times earnings multiple, yielding nearly 5%, that's the index. So obviously you can pick and choose. With the pound as low as it was, there are some good opportunities for the exporters. From Britain, most of the British market is comprised of exporters. And the new government, or relatively new government under Rishi Sunak, Prime Minister Rishi Sunak, who opposed Brexit, by the way, but he is now doing what the last government, or the last government of Boris Johnson, signally failed to do, which is he is negotiating trade agreements, which was the whole promise of Brexit, of course. You can't just leave Europe and not set up new trade agreements. He announced one last week with Japan and a group of Asian economies. and is trying hard to get the US to come to a trade agreement. But as we see, and that's a priority for this government, so as we see these trade agreements come into place with a low British pound, the exporters in Britain are going to do very well. And as I say, you're getting 10 times earnings multiples and almost 5% dividend yields. I like some of the Asian markets, but I'm very, very nervous about China at the moment. You know, we could get some incident in Taiwan that would see the China and Hong Kong market down very, very sharply in a very, very short period of time. But I do think there's some good, attractive companies that are good valuations in the Asian market. Singapore would be my favorite right now.
Well, I appreciate your analysis, and you've been very generous with your time. So thank you, Adrian. Thank you for spending the time to educate us today. Appreciate it.
Well, thank you very much, David, and good luck with the new show.
Thank you very much. We'll have you back soon to dissect more in the markets. I'm sure there's always plenty more to discuss, and I appreciate you weathering the cold to speak to us. So that's always you're a trooper, Adrian. Thank you for watching. I'm David Lin. Stay tuned for more.